I can't believe. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, what Walmart just said, is outright shocking and it has dire consequences for the U.S. economy. Plus, are we seeing renewed signs that deflation is starting to spread to the rest of the world, putting an end to this fantasy of a global soft landing? And is inflation now finally entrenched in the U.S. economy, or are we about to see it come crashing down in the next couple of months? And if you're wondering what we're doing in the United Kingdom today, well, let's just say they're facing the worst of all monetary phenomenons, and we're going to make the case of why it may be coming to America. And with that, let's over to Bloomberg, where we picked today's story up with a headline: Japan producer inflation slides below the latest CPI gauge. And one thing we note is that where factory prices go, consumer prices follow. So as we look to Japan, we're now seeing deflation. Where do we first see it? China. So it's starting to spread at a time when what do we continue to hear from policymakers? That inflation's entrenched. This is just a little bit of a slowdown. We're going to surge higher in 2024, and yet we continue to see signs that the economic data says demand is coming down, and where it starts at the factory, it eventually gets into the consumer, and all that tells us is that policymakers once again have it all wrong. The measure of input prices for Japanese firms rose a whopping 2% from a year earlier, but get this, it's the slowest reading since March of 2021, according to the Bank of Japan. The data compared with the expectations of a 2.4% gain, and once again, we see analysts missing the boat here that the likely path is disinflation. From the prior month, prices fell 0.3%, so there's some deflation versus the consensus for a 0.1% gain. The year-over-year result was weaker than the 3.1% August gain in the bank's benchmark gauge for consumer prices. The last time inflation for materials was slower than consumer inflation was back in February of 2021. And here we're about to see, of course, consumer prices. But what the issue here is, what they're talking about is producer prices. So we're looking here at the U.S. data, and we've got the producer price index, final demand, and I'm subtracting off the consumer price index. And this chart is really telling because it gives us an indicator here that you go back to 2015 into 2016 and what happened in the global economy. We saw a broad-based slowdown that almost ended in a global recession. And then what happened? Kind of in mid-late 2019, once again, the economy was slowing down, and here we see the same chart pattern show up where consumer prices are higher than producer prices. And what happened? The global economy started to slow, and then the pandemic hit. Now, what are we seeing? This much larger deviation between the two. The only difference is now everyone says that this is a soft landing. In reality, this is nothing likely a soft landing at all. We're facing a global recession once again, but here we have policymakers with interest rates jacked way up, financial conditions super tight. We have yield curves and money curves massively inverted, and yet they can't see what is about to come, and that, for many equity investors, is the wrong news, because right now we know around the world, not just U.S. investors, but investors are coming out of Asia and Europe and piling into global equities looking for a huge surge in earnings. But when you see, of course, producer prices leading consumer prices to the downside, well, what happens is you end up with lower corporate profits. And so here we have the producer price index and final demand in blue, shown on a year-over-year rate of change against corporate profits after tax. That's also shown on a year-over-year rate of change. And notably, when producer prices head negative, well, that's not a good sign for, of course, corporate profits. We see that again here headed into the pandemic, and now everyone thinks corporate profits are headed higher along with stock prices, but in reality, it's actually headed lower. So what we can note here is Japan exporting a little bit of deflation. And we're starting to see that trend in our base cases now. As demand goes away, it's going to spread throughout Asia, over to Europe, and eventually here in America. Now, we're not there yet. We're one of the last countries that will likely experience this, but now we're seeing renewed problems in Europe here as we look over to the United Kingdom, who's facing stagnation fears that persist despite late summer economic rebound. So what is stagnation? Well, that is when you see rising unemployment unemployment and rising consumer prices, it's usually not a good sign, because this is an issue. You have people losing their jobs and prices going up. They can't afford higher prices, and next thing you know, you've got a major problem for the economy. Now, we can note this does extend for a while, but in general, it's not a permanent fixture, and economies will show you why, as the figures reinforce a picture of an economy losing steam. And this is what we've been saying. The global economy is slowing down. We look everywhere around the world in the face of sharp increase in borrowing costs. Of course, it's always blamed that it has to be higher borrowing costs. The Bank of England held interest rates last month, fueling speculation that the most aggressive hiking cycle in the late 1980s may have come to an end. Now, you think about, as central bankers perhaps bring these rate hikes to an end, what usually happens in the bond market is we see rates come down as the bond market starts to anticipate that central bankers went too high and for too long and will then be forced to cut. And so now let's take a look. We talked about this trade setup on using our reports. And if you said, hey, Steve, I actually think interest rates are coming down, I want to do this bond trade, I don't know when to get in it. So we talked about this a few days ago using our reports. Here is the trade on TLT. You notice we have a question mark here, and we're going to show you an entry point, how to do this live on the show. Here we have our CTA-Timer Pro report from October 12th. This is today's report. And what do we note? TLT, 100% short across the board. So what I'm going to show you here is how our best traders leverage our two tools to get the most out of their trading account, just like you can. Now let's head over to Momentum Timer Pro. Right now, $20 a month. You can lock it in for life, and you get the first month free. How about this? TLT showing one positive change in momentum. So on a one-day report, that's what we're looking for. And when you see the two reports consistent match together, when you see the CTA report start to cover out of those shorts and you see momentum building, that is the signal you're looking for. That's what our most successful traders use, and that's what you can too. Again, links for everything in the description below, because as we look to the stagflation problem, I want you to see why it doesn't last that long. Here we have the consumer and price index, this shown in blue, that on a year-over-year rate of change against the 4-week moving average of initial claims, that shown in red. And you'll note I highlight some points here where you effectively have rising consumer prices and rising unemployment. It does happen, but what I want you to note that it doesn't last long periods. It can last for a year or two, but it's not an extended thing, because what happens as more and more people lose their job, what tends to occur? Well, their incomes, they go down. Their discretionary spending goes down. And eventually what happens to inflation? Well, take a look at this. Following each one of these instances, inflation came crashing down. You see it here into the early 1990s. You see it again during the dot-com bubble. How about the global financial crisis? And now everyone's saying, look, it's not going to happen again. Well, there's a big difference. Right now we're experiencing disinflation. So the general trend of inflation is slowing down, but we also have very low initial claims here, and the 4-week moving average is also very low. Now, at some point, we're going to make the case of why this 4-week moving average of claims is going to eventually head higher, and when it does, watch the consumer price index come crashing down. We think only about 20 or 25% of the impact of the interest rates hike have been fed through to the economy. So I think there's also this worry that might mean we're going to have to pay a higher cost than we should be paying. Now, this coming from the central bankers is dangerous news. If they only think, and now we're only looking at the United Kingdom here, but if you can imagine looking at all the central bankers around the world, if they only think that a quarter of what they have done has transmitted into the global economy and into their local economies at their country, then we have major problems here, because we're already slowing down. And if indeed these lags, and they'll talk about that, you hear central bankers say there's lags in monetary policy. They're variable and long. Well, how long? We don't know. How variable? We're not sure. You think by now they'd know, but they don't. So one of the challenges we're facing here is, if indeed we've only seen a quarter of all of these rate hikes come out into the real economy, watch out as the rest of them with that lag shows up. It means the slowdown is going to get a whole lot worse. And the outlook for the economy remains lackluster as high interest rates continue to bite. Today's data is consistent with our assessment that the economy, this is in UK, entered a broad-based slowdown in the late summer, which has deteriorated further in recent months. So we'll note it hasn't gotten any better. And that's one of the issues here is the global economy isn't getting any better and is likely to continue to get worse until we start hearing people admit that perhaps these countries are entering a recession, eventually the U.S. likely being last on the list here to come. But look what's going on in the UK, because this is something that we will see in America. As UK banks set to restrict mortgage supply after defaults rise. So this is pretty interesting. What did we see happen here? We see central bankers invert yield curves and money curves. So banks stopped creating new loans because, well, they couldn't make any money doing it. And when they couldn't create enough new loans, new money doesn't enter the economy, and all of a sudden you do not have enough new money to sustain growth and pay on the debt. So what inevitably happens is you start to see people run short of money and they enter delinquency because they can't make their payments. And then what is the response from banks? Oh, well, we'll just cut credit access even more. So effectively, you see this negative feedback loop where the banks, by curtailing lending at every step of the game, are going to face massive defaults and massive delinquencies that will turn into defaults and an all-out financial crisis. The Bank of England's quarterly credit conditions survey found that lenders decreased the supply of mortgages in the third quarter and will restrict availability further in the coming months. Defaults and losses on home loans picked up in the third quarter as more households are forced to refinance and much higher interest rates. And if you restrict credit enough, then asset prices come down too. The next thing you know, not only the banks be facing a lot of delinquencies and defaults, they're going to be upside down on the value of these properties. If it sounds like the global financial crisis again, well, that's what happens when central bankers and governments inflate massive amounts of credit into the economy and then try to restrain it. It only becomes a matter of time before the bubble pops. And banks said the demand for unsecured lending, such as credit cards, increased in the third quarter and was expected to climb again in the coming months, which shouldn't be a surprise because it suggests that struggling households are turning to debt to make ends meet, as demand for mortgages was likely expected to fall because you can't get one. So we know when people run out of money, and we've been making this case this is going to happen, that they're going to tap every available credit line that they can get. When banks have had enough and say no more, that is when the music finally stops. The consumer stops spending, and you're going to watch the economic data come outright crashing down. And as we look forward to hearing what Walmart has to say, it may have already started. And lenders expect defaults to rise on mortgages. Well, they should when people aren't making payments. Unsecured lending and loans to small and medium-sized firms in the fourth quarter, suggesting, as we've been saying, where the economy around the world is running out of money. But one place that doesn't seem to be there quite yet, that's the U.S., as the consumer prices rise at a brisk pace for the second straight month. And all this is going to do is give some Fed some ammunition to perhaps threaten another hike in the future. We know right now, based on what we're hearing from the members of the FOMC board that are out on the speaking circuit, that they're likely to pause in November because they believe that the move higher in long-term rates needs to feed through the economy. They're going to want to wait and see. But don't worry, they're going to continue to threaten higher rates. We're going to make the case of why it won't be a whole lot longer before inflation comes crashing down. The recent inflation data underscores a strong labor market and how it's underpinning consumer demand, which risks keeping price pressures above the Fed's target. At their meeting last month, the majority of the officials saw a need for one more rate hike this year, and they may maintain that bias despite a recent surge in yields if inflation doesn't cool further, opening the door for a December hike. But we're making the case of why inflation is eventually coming down and unemployment is headed up. We're going to throw out the CPI chart for a minute and put in the total compensation chart, because ultimately this is what matters. If you're seeing total compensation growth slowing, consumer prices are going to slow because people don't have as much money. So here we have average weekly hours multiplied by average hourly earnings of production and non-supervisory employees. This shown in blue on a year-over-year rate of change against the 4-week moving average of initial claims. And sure enough, what do we see as total compensation growth slows? Well, people spend less, and if you spend less, people need fewer employees. And sure enough, you'll notably see the 4-week moving average of initial claims tend to rise shortly after that. You see it here again around 1994-95. We see it here in the dot-com bubble, again in the global financial crisis. Now, we're not seeing it here yet because total compensation growth was so high relative to the norm that if it continues to slide from this point point, that's where we're really seeing demand destruction, and we should start to see some layoffs start to build steam. The advance reflected increases in housing costs, car insurance, and recreational services like tickets for sporting events. Used car prices fell by the most since early this year, and motor vehicle parts declined by the most on record. So as these price increases get embedded in the economy, the rate of increase will likely to slow, and that will kind of validate the continued disinflation trend that we're seeing here in the CPI. Meanwhile, shelter prices, which make up about a third of the overall CPI index, accounted for over half of the increase in the monthly advance and were boosted by the biggest jump in hotel stays in the last 2 years. Now, I can tell you, as someone who lives in the vacation capital of the world, well, all these theme parks and resorts are starting to offer discounts on rooms and park tickets, and when you go to the parks, they're just not as busy, suggesting that whatever this last couple months of boom was, it's gone, it's over, and people around here are starting to panic, suggesting that what we know about the CPI in the coming months, it's likely to go down. And looking ahead, a sustained moderation in this category is essential for a downward trajectory of core inflation, which we can expect. And after showing some progress, Americans' wages, here we go, back to wages, are no longer keeping up with inflation. A separate report Thursday showed inflation-adjusted earnings fell for a second straight month at minus 0.2%. So again, if consumers can't keep up with inflation in their spending, what does that mean they're going to do? Well, if you said spend less, you got it right, and that's where we're getting over to this Walmart story, because it looks like it's already started. And while many forecasters now see the U.S. skirting a recession, the economy's outlook remains uncertain. On one hand, unemployment is low, which is true. Hiring remains robust. That is somewhat true. And households seem to have more excess savings than previously thought. But I don't think that's going to be true when we look at this report from Walmart. And on the other, small businesses are growing more pessimistic about the outlook. Borrowing costs are high, and the resumption of student loan payment risks are denting consumer spending, which we should find out here shortly. But look at this. From Walmart, now consumers starting to buckle for the first time in a decade, for the first time since the last recession. This according to former Walmart U.S. CEO Bill Simon. And this is a big warning, because if the world's largest retailer is seeing a problem and a slowdown, that means broad-based, the rest of the economy here is doomed. He's blaming a list of headwinds weighing on consumers, including inflation, higher interest rates, federal budget wranglings, polarized politics and student loan repayments, and now new global tensions connected to violence in Israel. He says that sort of pileup wears on the consumer and makes them wary. For the first time in a long time, there's a reason for the consumer to pause, and I think the big reason is they're running out of money, which is why we're outright shocked, because look at this. He points out they usually say a 50-inch TV is $199 or something like that, and now they're saying that 50-inch TV is 40% off. He says use percentages when you're not really proud of your price point. I think you've got inflation pushing relative price points up at a time when consumers are not keeping their wages up with inflation. We know broad-based total compensation is falling, and even though people fixate on the wage part, it's hours worked that matters a whole lot. And here we can see why we know total compensation is likely to continue to head lower, because when you look at that, here we have in blue, total compensation against the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. And why this matters is because when banks restrict credit and the creation of money, that means there's less money to give people raises. That means less money to spend in the economy. And sure enough, what do we see? Banks tighten lending standards, total compensation down. You see it here going into the dot-com bubble, same effect. Total compensation came sliding down. You see it during the global financial crisis. You're seeing it now. The difference is no one actually believes this is going to happen. And if we continue to see the banks restrict credit, which we know they're going to do, that less and less money circling the economy is going to go away. And next thing you know, what we're going to see is these weekly unemployment reports are going to change in a big way. For the time being, 209,000 claims last week, which is super low historically, bringing the 4-week moving average down to just over 206,000. But how about this? Continued claims. This is not a good sign that you want to see. This means people that are on unemployment are struggling to find work, and that means more people are struggling to find work. We're now up to 1.7 million, but total claims down to around 1.6 million. I think that's where we see the big inflection point coming. is when all of this tighter money conditions eventually feeds back, and next thing you know, we'll see employers start to lay off. They won't want to. Now, I want to make that point clear. I don't think they want to. I think they're going to have to, and that's why when we hear from companies like Walmart, particularly their ex-CEO suggesting that consumers are starting to buckle, it means the U.S. economy is not far, perhaps months away from entering a recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.